You just, yeah, all right, so that's good. Okay, wonderful. Okay, all right, so an author, I've got 6 kids that we have homeschooled for the last 10 years of our life. Obviously, I have a husband. He is a stay-at-home dad. He works on our farm. I speak and teach and educate people on this exact topic on how they would be brain dead, not own a home-based business, how they can free up money. And I've been a tax strategist now and accountant for over 25 years. So this is all I've really ever done my entire life. I didn't like accounting for a while, so I did, which who does, who loves taxes? But what I really focused on was being a business owner. And so it always came back to strategy. So we have got to figure out, how much money we're bringing in, how we can free up money as much as possible. And so I really love the strategy piece of it. We have a full service accounting firm here in Greenville, or actually Greer, kind of the outskirts of Greenville, South Carolina. And so I have 10 employees that work for us. We have payroll department, we have a bookkeeping department, we have a tax department, and then I do all of the strategy. So, we hit the 5,000, 2020, super proud of that, and 2021 as well. But again, my goal here is just to provide you with knowledge so that you can either, one, do it on your own, or two, we can actually help you in the process. But the name of my talk today is Why You'd Be Brain Dead Not Own a Business, and I'm going to share with you many reasons why you should have some sort of business if you don't already. That's going to be the first step that I want you to try to find something that you're passionate about that you can open your mouth about and start telling people about it. And the reason why is just the tax benefits alone. It has nothing to do with the fact that one business is better than the other. It's just the tax benefits that you get by being a business owner. So, what you're going to learn today, a couple things. Taxes are our number one expense. So you will pay more literally in taxes than food, clothing, housing, and transportation combined in your lifetime. So we have to do everything we can legally, morally, and ethically to keep as much money as humanly possible in our pocket. And the average family, what I've found by not having a business, the average family is actually going in debt about $4,000 to $8,000 a year. And so we're going to share why you should be a business owner, but then I'm going to take you through some steps if you already are a business owner, why you need to stay in this system and why you need to continue building your business and how much money you can save by doing so. I'm going to teach you the 2 tax systems in our country and why you'd be brain dead not own a business, why 93% of business owners overpay in taxes. So we're going to go through some things. And the goal here is to help you keep 10,000 or more this year in taxes so that you don't have to give that over to the government. So why are we different than a traditional accounting firm? And if you've ever worked with me in the past, you'll know that what we focus on is strategy. So most accounting firms, we're not taught this information in college. So I didn't go to college and them teach me how to save you money in taxes. I went to college, and the majority of what we spent time on as an accounting major was bookkeeping and financial reporting and reviewing financials. And there was one class on corporate tax returns, and there was one class on personal tax returns, but there was no strategy. So the government is not going to teach us how to keep our money. So that has got to be something that's put on us as individual business owners on how are we going to free up this money? How are we going to keep more money and put it in our pocket? So really, as much as we do all of the back end paperwork that needs to be done, our focus in this company is to free up money. So we're not going to do anything for you unless we can find you money on it. These are some of the tax savings from our clients. The most that I've ever gotten back a client is $338,000 in 1 year. Just kind of give you a little bit of background. The client wasn't properly structured. They were told incorrect information by their accountant. They were missing expenses. So we went back and did all of their bookkeeping. And then on top of that, there was just some strategies that we put into play that was able to not only free this money up throughout the year, year after year, but also to allow her to go back and get that money back. So another client, Carrie, we did $110,000 a year she overpaid. We went back and amended 3 years worth of tax returns and actually got her back $330,000. So took a while, took us about 6 months to get the money back, but sure enough, they sent her a check. So we've been able to help clients get back over $10 million over the last 7 years that I've been actually tracking the amended tax returns, and we help clients continue to save millions of dollars every single year. So I just shared this, but I think it's very important to share it again. And guys, you're welcome to take pictures if you want. You're welcome to share this information. This is not proprietary. I'm just trying to get the word out to help people understand all the benefits of being a business owner. But the average American will spend more money in taxes this year in their lifetime than they will on food, clothing, housing, and transportation combined. And most people don't think about that, but when you think about sales tax and you think about income taxes and you think about business licenses and all of these things, they add up. And the average American is actually spending about 40% of every dollar they make in taxes. And the average American family household is going in debt $7,000 to $12,000 a year. And so I'll break that down for you so you understand in just a second. But the national debt in our country is actually higher than this now. I just looked it up yesterday. It's $107,000 per citizen, and which is every man, woman, and child. In 2020, it was $67,000. So that will tell you what the pandemic has done for us. But the credit card debt, $7,400 a person. Student loan debt is $39,000 per student. So what we are currently taught, obviously, to go to school, get good grades, go get a good job, it's not working for the average American family household. And I'll show you how to fix that. But I want you to understand, here's the breakdown. So the average household in America in 2024 is making $67,000 a year. That was in 21, and I want to compare this back to 2020 because I think it's important. In 2020, we were making less money, about $61,000, but on average, they pay about the same taxes, $14,000 in taxes. That leaves a take-home pay of $53,000. The problem with that, and the cost of living has actually gone up since this number, because I pulled this the beginning of last year. The cost of living in America is $65,000. It was $53,000 in 2020. So even though people are making more money than they were in 2020, the cost of living has gone up considerably and the taxes have not really changed that much. If you make more money, you're obviously going to pay more money in taxes. So the average family household, if you crunch the numbers, is going in debt $12,000 a year to work 40 hours a week, 50 weeks a year to take 2 weeks paid vacation. This system is broken. This is considered to be the W-2 employee tax system. And if you do not figure out a way to get out of it, I'm not telling you have to quit your day job. I'm telling you to just add a business on the side so that you can start being able to write off expenses, things that you're already spending money on currently, be able to write those off as business expenses so that you can have more money back in your pocket. Naturally, tax planning is better done in 2025 for 2025. So I have so many people that come to me now. I have tax strategy sessions the entire month of January, and it's like, how can I save money for 2024 in 2025? It is harder because obviously I can't tell you to do things that I would tell you to do the last 2 weeks of the year. Pay extra expenses up, maybe structure your business differently, but there is still ways that you can free up money this year. Two of those biggest things is the structure. So we can look at an LLC treated as an S corporation. So that may be a good fit for you guys. And then we also look at obviously expenses. So if there's missing expenses there, that's going to cause you to overpay in taxes. So it's not too late to save money now. It's just not going to be as much money as if we actually did some tax planning last year, but we can get there. And everything that I'm sharing with you today, people typically say that I'm like a fire hose. I'm going to give you a lot of information. And the goal is not to overwhelm you, but to help you understand. You don't have to learn it all. we can handle all of this paperwork for you if you want us to. And so you don't have to learn it and do it all yourself. That's just the plain and simple. But I'm going to throw a lot at you. I'm going to give you a lot of ideas on things that you can write off. And some of them may apply and some of them may not. So starting a business. One, we already talked a little bit about starting a business. I truly believe that we have to figure out a way to get out of the tax system that was created for the W-2 employee tax system. So there's two systems in our country. There's the W-2 employee, and then there's the business owner tax system. And the goal is obviously, as a business owner, right, we are pushing money into the economy every single day. We are then hiring employees, and those employees are going to end up paying the lion's share of taxes. So you may think, well, that's not fair. But at the end of the day, if we had the same tax benefits as a W-2 employee, which is next to nothing, we wouldn't be able to hire the employees. So the government, Congress, knows that it's very important to have businesses out there building a business and hiring employees, and then the employees then pay the taxes. So as a W-2 employee, regardless of what you do, you will always pay less in taxes as a business owner than you will a W-2 employee. So, and I like to explain it this way. I actually created this slide to break it down for you to show you exactly taking a person who's making $100,000 a year, or a family making $100,000 a year. It shows the taxes, the FICA, federal, state taxes that they would be paying as a W-2 employee with a standard deduction. Here's the take home is $71,000. And if you have a business owner, same $100,000, with around $25,000 in deductions. And I'm not talking about spending money that you aren't currently spending money on. What I'm talking about is actually taking your living expenses and being able to redirect those as business expenses and get a massive tax deduction for that. So what that looks like is you've got the $100,000. Let's say you've got $25,000 in business deductions. That leaves you $75,000. You have something called a QBI deduction. This is something that President Trump put into effect back in 2018. It's coming up again this year. Hopefully it will be extended and even greater. He's actually promised that he's going to give us even bigger tax cuts this year. But the QBI deduction says that you don't have to pay tax on 20% of your net income from your business. And so that leaves us with $60,000 taxable income. And then you have a standard deduction from there. Is $15,000 per person. So if you're married, it's going to be double that, obviously. And so here's the taxes on that number. You've got self-employment taxes that you would pay, and I'm going to show you how to lower the self-employment taxes in just a few minutes. You've also have federal taxes, you have state taxes, and then your take home is $86,000. You can see easily that the difference between being a W-2 employee and owning a business making $100,000 a year is about $14,400. So that's huge. I mean, that really is. And the more money you make, obviously, the more money you're going to be able to keep in your pocket as a business owner. And again, if there were vehicles involved that were bought, or, business use of home and all these different deductions, you can actually get that number down even lower. So a person who's making $300,000 or $400,000 a year as a business owner could be essentially paying the same amount of taxes as someone who's making $100,000 as a W-2 employee. So, why do business owners get massive tax deductions? 70% of all jobs in our country are created from small to medium-sized businesses. Period. End of story. That's why we get massive tax benefits, is because we're creating jobs in this country. And why is it important to do strategy? Well, 40% of every dollar that a salaried employee makes is going to pay taxes. So we have to figure out a way around that. And pretty much with my aha moment, I didn't figure this stuff out in college. I actually sold a business, and the guy I sold it to stopped paying me about 12 years ago. I had a really large insurance agency when I was 30 years old. And the guy stopped paying me, and I lost everything. And I actually had to start over working from home and having a home-based business. I'd always had an office. I felt like being a professional, you had to have an office. And so I didn't realize the massive benefits of having a home-based business. And at that time, one of the really good books that I started reading was a book called Lower Your Taxes Big Time. A guy by the name of Sandy Botkin, IRS attorney, CPA. He worked for the IRS for 5 years and trained attorneys. And I learned more from his book in a matter of probably a week of reading it than I did in my entire education in college. And the reason why he was giving strategies that I was actually taught that was not existent or not true, or that it would cause my client to be highly audited. I will tell you this, as far as audit potential, we have had less than, I would say, 15 clients audited over the last 25 years of me being an accountant. And as far as corporate returns, we have had 3. So, and we've won, I would say 9 out of 10 of every single one of those returns. So, or every single one of those audits. So I don't want you to be concerned about that. We definitely include audit protection on every tax return that we prepare, but it's just a precaution and it keeps us from having to deal with it with a firm that actually handles nothing but audits that would take care of you if you get audited. We step in at any point in time if we need to, but that's kind of the way we work here. So I started doing taxes for people. I actually got involved in a network marketing company, and I started doing taxes for people in that network marketing company to prove to them that by having a home-based business, that they were far better off paying their dues for the company that they were involved in and getting the massive tax deductions that came along with it. And I did over 900 tax returns in one company, and I showed that I could give, on average, a family, average household, $4,000 to $8,000 a year in tax savings. And so that was life-changing. If you can help someone get out of the hole and actually start, producing income throughout the year, then that was a huge deal. So that's when I really started back. It wasn't necessarily out of want to do taxes, but I wanted to be able to help people. And I started doing these tax returns, and I'm like, man, you really would be brain dead to have not to have a home-based business. And so, that leading into, we've got now, you understand why you have to have a business. Then I need you to understand that 93% of all business owners are overpaying taxes. And the reason why is typically when I see is 4 things. The lack of knowledge. 1, they don't know anything about strategy. Their structure's they're not set up properly as far as their structure. They're not writing off the expenses that they're entitled to take because they're either scared of an audit, or they don't know that those are actual tax deductions that they're entitled to. The second is is being scared of an audit. And so I want you to understand, and this is not something I learned in college, because I was taught in college, just like you probably were taught by your accountant or CPA, that expenses actually trigger audits, but they don't. They have nothing to do with it. So a dramatic increase in your income or a dramatic decrease in your income is actually what triggers an audit. And if you are over $500,000 a year, you are extremely highly likely to be audited at some point. And as a business owner, you have a 77% chance of a likelihood of being audited over a 20-year period. But again, it's very highly unlikely. And so we will work with you to share with you how to audit proof things, how to force things to be tax deductible, but you shouldn't be scared of an audit. As long as you are truly attempting to earn an income, which per the IRS is literally 3 to 5 days a week, spending 45 minutes at a time. If you're doing those things, then you don't have to be scared. Just make sure that you're tracking your expenses and that you're keeping up with receipts. I'm not the best at receipts. We'll talk about, what else you can do to keep from having to have all of your receipts by having some sort of accounting software. But first and foremost, I just don't want you to be scared of an audit, because at the end of the day, if you are attempting to earn income, you're entitled to take these expenses, and you should be taking advantage of those. Third thing is accountants are not allowing expenses, or they're giving bad advice. So if your accountant is telling you that something that without a shadow of a doubt is a tax deduction and you are using that to attempt to earn an income, you might want to find another accountant. So a conservative accountant is not someone you're looking that you should be looking for. You should be looking for someone who is a strategist who is really focused on saving you money. And I want to share with you this while I've got you on this slide. There is a difference between a CPA, which is a certified public accountant, and an enrolled agent, which is an EA. I'm an EA, and the difference is a CPA works only for the state that they're in. So they actually have a state licensing board with a CPA firm, or they're CPA and they have a state licensing board, meaning they can only operate typically in that state. Their focus is financial reporting and doing bookkeeping and auditing and things like that, as opposed to an EA. So an EA is the only credential that you can get from the IRS. It's considered to be the highest credential. We can go to tax court. We can defend you on any audits. We can do, and our focus is tax law. So I want you to understand the difference, because we're taught that we want to go find a CPA when a CPA's real focus is financials, whereas an EA is their focus is tax. And so if your CPA is telling you and advising you not to take advantage of these deductions or not to be structured properly, it's just because of their lack of knowledge. They're tax preparers, not tax strategists. And then the fourth thing is accountants not providing strategy. Again, I just said that. They're focused on preparing tax returns. They understand that you've got to process payroll for certain things, that you've got to have bookkeeping, that you've got to have, your taxes done, and that is their only focus. The majority of accountants are not out there trying to help save you money. And a lot of times, sadly enough, we're taught in college and every continuing education event that we go to that if you are overly aggressive with a tax return for your client, then the client gets audited and then you could lose your rights to ever file a tax return again. So a lot of the reason why you're not getting these tax savings and these tax tips and strategy is because your accountant is scared of the government. I have done taxes for too long and have seen the truth about how many clients get audited and what causes an audit to know that I'm not concerned about the government. I'm obviously going to do everything I can legally, morally, and ethically to help you keep more of your money. We're not going into a gray area. That's not what I'm talking about. I'm not going to be so aggressive that, we're going to write off every single thing like your grocery bill or something like that. But we're going to do what is legally allowed for us as far as business owners. So, and I talked a little bit about this, but just 3 easy ways. This is kind of what I work with you in the tax strategy session one-on-one, is making sure that you're tracking and writing off all of your expenses. One of the biggest reasons why people ever pay in taxes is they're just not tracking the expenses, and they're not writing off things that either because of lack of knowledge or because they're scared to write them off. If you are using a personal expense as a business and you're using that to attempt to earn an income, you can force that to be a business expense and you can write that off. There's some limitations on percentages of business use, and we'll talk a little bit more in detail on that. The second reason why people are overpaying in taxes is they're not properly structured. One of the biggest things that I would tell you, if you have not already set up, is an LLC. So I would definitely get that in place, which is a limited liability company. One, if you're not in the network marketing industry, the minute you start a business, there's liability or there's potential liability, and you should have an LLC just for the liability purposes. But we have an ability, once you have that LLC in place, and we can help you get that set up, we can treat that LLC as an S corporation for tax purposes and help save substantially on that. And I'll show you how that works in just a second. And then the third thing is just paying yourself too much. So I have so many clients that come to me and they're structured properly. They have an S corp election, and which we can help you do as well. And their accountant is telling them that they should be paying themselves, 50 or 75% more than they actually could. or actually should. So we go back and we amend the payroll tax returns, we amend their tax returns, we get them back money that they're overpaying just because they're getting bad advice from their accountant. Now, let's go into detail on what an actual tax deduction is. So after this, I'll actually send every single one of you a deduction spreadsheet that I've created that I give to all of our clients, and they can actually see the breakdown of everything that they can write off. There's over 167 different deductions on there. Naturally, there are more deductions, but that's all that I could fit on one page, and those are substantial in what we typically see as far as business owners go. That could be very helpful. Granted, anything else that's not on there, you can obviously write that down and list that. But a tax deduction per the IRS, this is how they break it down, is any expenses incurred for the purpose of gaining or producing income. It's incurred with a reasonable expectation of resulting in future business, and it's reasonable under circumstances. So what does that actually mean? It means that if you're attempting to earn an income today or in the future, and it's reasonable, is so if you're someone is unmuted. So let me see here.
Help. Can you please get, I think I left my keys inside. Can I trouble you? I'm so sorry.
Stella, if you could please mute yourself.
Thank you so much.
Stella, if you could please mute yourself. You are unmuted.
Sorry. So sorry.
You're fine. Okay, let's get back. Sorry about that. All right, so now, what is not reasonable? I would say if you just got started in business and you are trying to buy a Bugatti or a yacht, that's probably not reasonable. But if you are making $10 million a year, which I have one client that makes $18 million a year in the network marketing industry, his whole entire lifestyle, we pretty much write off. And the reason why is because it's a lifestyle business and he's showing people his lifestyle, and that's obviously bringing in clients to him. So that we can force to be tax deductible. But, you know, I was a platinum partner with Tony Robbins for 2 years in a row. That's $85,000 a year for continuing education. Personal growth and development, advertising, you know, meeting and networking with people. That is a legitimate, reasonable expense because I was using that information in order to grow my business. And I was also utilizing that in order to go and meet new people so that I could get new tax clients. So I could prove that I was easily using that as a business expense. So that's reasonable. I was expecting future business from that, and I was, you know, hopefully producing income. The intent was producing income. And that's the same thing with anyone else. Any expense that you have, I look at it and say, is your intention to make money spending this money? Yes. If that is true, are you attempting to earn an income with it? Yes. Now it's tax deductible and you should be writing it off. And the great part about that is that we can actually force living expenses, things that you're already spending money on today, and force those to be tax deductible as business expenses by attempting to earn an income and doing daily business building activities. Like I said, the IRS considers you being a business owner and in business attempting to earn an income if you spend 3 to 5 days a week, 45 minutes a day, attempting to make money from your business. That could be sending out emails, text messages, posting on social media, sending out messages to clients. It does not matter what you're doing as long as you are truly attempting to earn income. It could be going to meet with business professionals. So, and the great part about business expenses is that the government actually allows you to use any losses. So if you lose money in the first year, third year, fifth year, whatever, you can actually offset any of those losses against any form of other income, and you get to carry those forward forever. So a lot of people, and I'll go ahead and knock this myth out of the park right now. A lot of people are told that you can't have a loss more than 3 out of 5 years in your business. And if you do, it's considered a hobby. Well, that's not what the law says. The law actually says that if you are attempting to earn an income and you have a loss more than 3 out of 5 years, the burden of proof then shifts to you after the 3 years to prove that you are truly attempting to earn an income. If I were losing money because I'm hiring my kids and I'm buying vehicles and I'm spending on advertising and I'm going to continuing education events and I'm writing off all of my travel that I can, that's obviously part of that could be vacation, but I force it to be travel deduction. I can show a loss. I just have to prove to the IRS that I really am trying to make money. And I can easily prove that by my calendar, by what I'm doing. You can see that in your actions and results. So I want to knock that myth out of the park and then, help you understand that as you continue, obviously the goal is to make money. But in the, 3 to 5 years, Amazon didn't even make money for the first 11 years. So that would be like saying, well, Amazon, sorry, you can't write off these deductions because you haven't, you're losing money. That's not the way it works. So if you have expenses, you can write those off, offset that against any other income that you have. So what tax deductions can we write off? I'm going to give you a handful of different things that can be written off. Again, I will send you my deduction spreadsheet when we get off the call. I'll email everyone out that deduction spreadsheet so you have that, and you're welcome to share it with anyone that you want. We talked a little bit about converting the living expenses to business expenses, and I want to give you some detail around that so it kind of helps you understand. If I take a W-2 employee, you'll see them on the left, their living expenses, they only, as far as deductions go, they really only get itemized deductions. And 96% of Americans get zero benefit from itemized deductions. And the reason why is because there's limitations. So medical bills, medical insurance, you have to go above 7.5% of your adjusted gross income in order to get any benefit from that. Most people do not. Property taxes, real estate taxes, all taxes are capped at $10,000. Even income taxes are included in that number, but there's a cap. Mortgage interest, if you have a house that's over $750,000 a year, you don't get benefit from any mortgage interest over and above that, but you can claim the mortgage interest under that. And then charitable contributions. Charitable contributions can't go above 60% of your adjusted gross income. Again, I know I'm throwing a whole lot at you. Don't expect you to remember this stuff, but just want you to understand there are massive limitations on itemized deductions. On top of that, you either get the standard deduction or you can do the itemized deduction. So this year, 2025, the itemized deductions are actually $15,000 standard deduction is $15,000 per person. So $30,000 for a family or a couple. And so unless your itemized deductions go above that 30 grand threshold, there's no benefit for you at all whatsoever. So essentially you're getting no deductions for being a W-2 employee. Now, the other part of that are living expenses. So things like meals and auto and cell phone and travel and obviously kids. Now, some of you may say, well, I get a dependent daycare credit. Well, the most that you get is $2,500. So that's not a whole lot. But everything else is non-tax deductible for you. As far as when we add a business, so if we have a W-2 employee that adds a home-based business or you're a business owner, you can actually force all of these things to be back tax deductible. Medical bills, insurance, that can be written off. And I'll go into a little bit of detail on how to force that in just a little bit because there's a plan that you have to put in place. Property taxes, if it's a vehicle being used for business, a portion of your home, property taxes can be written off if you're using your home for business. Business use of home, charitable contributions actually can be forced to be a business expense, and I'll go into a little bit of detail on that. Things like your mileage, your meals, your cell phone, travel, internet, all of these can be tax deductible. And so now we're not necessarily spending more money. We're just redirecting the living expenses and turning those into business expenses. Now, there's other expenses for your business. Obviously, you've got things like advertising and continuing education, and you may have dues and subscriptions or software that you have or cost of goods sold. But the majority of the expenses that you have, you're already spending money on. You're just not getting a tax benefit for those. So, granted, I just added in, these are kind of what I see on a daily basis. Kind of averages is not minimums or maximums. It's just, what I'm seeing. And the average business owner, once you start a business, can now take their living expenses, redirect those as business expenses, and have $25,000 to $35,000 in deductions. Well, if you're in a 24% tax bracket, if I take $25,000 and 25% of that, that's $6,200 back in your pocket. So it can be really substantial. Obviously, the more money that you're making, let's say you're in a 32% tax bracket, that's $8,000 that it would save you just by attempting to earn an income and redirecting your living expenses. So now, one thing I really love to do is shift income by hiring your kids. And there's obviously another way to shift income off of you and onto your kids by actually making them a part owner in your company. That's what we've done with our kids. We actually now 30% of our entire company is owned by our children. They're at a much lower tax bracket than we are. We would be at a 37% tax bracket where they're at a 12% tax bracket. So it actually saves us a ton of money by shifting off a percentage of ownership of our company onto our kids. When they were younger, the majority of our kids are over the age of 18, but when they were younger, we hired them and we paid them. And now you can actually, you hire your kids, you pay them, and then they in turn pay for their stuff. So it's now $15,000 per child that you can pay, which is up to $5,000 a year in savings, depending on your tax bracket. And we can obviously help you with all this paperwork, but you can pay the kids. If you can pay them $5,000 a year, you can pay them up to $15,000 a year. What I would just tell you to do as far as children are concerned is that you want to make sure you're paying them a reasonable salary for whatever they're doing. They could be cleaning house for you. They could be a personal assistant with you, go to events. They could help you with social media marketing. You can also hire them for modeling. So you can utilize them on social media, post them, and that you can actually pay them a modeling fee. So anything that you would pay someone else to do, you can pay your kids to do exactly that same thing. And if they're under the age of 18, there are no taxes whatsoever. So we have to set this up separately from this shouldn't be paid through a corporation. It should be paid through a Schedule C. But we can help with that. But under the age of 18, there's no FICA, no federal, no state, no taxes at all whatsoever, no unemployment. And that all of that income can obviously be offset and become a business expense for you. As far as it's concerned, you can spend this money however you want if you move it into a bank account with their name and your name on it. So you can't move the money back, meaning that you can't just transfer money into your kid's bank account and then transfer it back and say that you paid them. You actually have to transfer it over into their account. You could set up things like Roth IRAs for them. They could pay for vacations. They could pay for their stuff, their education. All of that can be taken care of through kids' payroll. There's also some really good employee benefits to hiring your kids. And this also goes into play for your spouse. You don't have to actually pay them as much for spouse payroll, and I definitely wouldn't suggest that you do. We'll talk a little bit about spouse payroll in just a few minutes, but one of the things I really took advantage of with my kids was taking them with me to events so that they could learn the same information that I was learning from Tony Robbins, from Les Brown, from Eric Worre. And so, we've got an event coming up next week that me and my son are going to. And he works for me. He's actually helping us in marketing. So you can take them with you to events so they can actually learn firsthand and you get to spend time with them. So I would typically take them a couple days on the front end or a couple of days on the back end, and we would enjoy ourselves and we'd be able to write off all of the travel. There's also, you can offer auto reimbursements for any employee. So you could do that for your kids. There's college education. When they get over the age of 20 or 20 or over, you can actually give them up to $5,250 a year for college education. So that's another deduction that we can add in. And then one thing that most people have no clue, this is actually tax code, and it says that if you allow your employees to utilize on your property, so they have to be working on your property and have access to a swimming pool, an exercise facility, a golf course, or a tennis court, that you can actually write that off. So, if you're working from home and your kids you've hired your kids, not only can you write off your swimming pool, but you can write off their travel, their education, all of those things. And so, even bigger, now that all of our kids own part of our company, then we have events that we go to and we get together. So it may be like, it would be considered a vacation for you, but for us, we can actually go and spend 4 hours talking about our business, attempting to earn income, and then we can enjoy ourselves and be able to write off all of that as a business expense. Now, travel expenses. So how do we force travel to be tax deductible? I think a lot of people ask me this question, so I think it's super important that I help you understand that. Excuse me. There is what's called on the road travel, meaning that you are driving to a facility or you're flying to a place. All of your food, your lodging, your laundry, all of that can be tax deductible, and you do not have to put forth any work on those days. So that's actually on the road to and from. So whether you're driving or flying, taking a train, bus, whatever, that's all going to be tax deductible and all can be written off. Now, transportation. You can write off the cost of getting to and from. So we talked about that. And then you also, as far as expenses go, meals is the only exception. It's limited to 50%. So you can write off 50% of your meals. And the cool part is that you don't have to keep receipts under $75. So I know, if you're going anywhere with 2 or 3 people, it's very hard to spend less than $75 per receipt. But this is one major caveat for travel. So if you lose a receipt, you don't have to worry about it. And again, I just want to share this because this is another myth buster. Most people think when you get audited that you are required to provide all receipts. That is the case if you have just an Excel spreadsheet or if you do not have documentation of how you came up with all of your expenses. The auditor is going to request that you provide all receipts. But if you've done a good job of inputting your information into a bookkeeping software or an accounting software, then it's going to be tracking every single transaction that's coming through your bank account. And you're less likely to have to utilize those receipts because you can then pull a P&L, a balance sheet, a general ledger. They can match up back to your bank statements and your tax return. And then so the auditor has 4 pieces of information in order to carry forward and make sure that your tax return matches your bank statements as opposed to just an Excel spreadsheet and receipts to match up. So I'll give you a link to a really good software that I would suggest that you use. QuickBooks is great, but it's very expensive for most business owners. Hurdler is one that we suggest that you use for business owners. It's very easy to use, and I'll give you a link on that at the end of this. So no receipts required under $75. And before I get off of the travel piece, I want to help you understand how you can force a vacation to be tax deductible. And first and foremost, it's not a vacation. It's a travel business expense, right? So if I want to go, let's say to Hawaii, I have clients in Hawaii. I have clients in all 50 states. And so I want to go to see some of my clients in Hawaii. But obviously, while I'm in Hawaii, I want to enjoy myself. So I can, one, either schedule appointments with my clients, or I can find an event that's going to be in Hawaii that would have to do with my business. It would actually help me run my business more smoothly, continuing education. So let's say I fly in on a Thursday. That's a travel day. So all of that's included. Granted, I can also bring my spouse who owns part of my company, and I can bring my children as well. So they own part of my company, and before that, they were my employees. So I can bring them as long as they're helping me with my business. We can go to this event. So Thursday, I come in. let's say I get in at 10 o'clock in the morning, can do anything you want to that whole entire day. You do not have to do business that day. Friday morning, we have the event, and that lasts for 4 hours and 1 second. 8 to 12, 9 to 1, whatever. So while I'm in that event, I'm putting in time. That's my business day. So the IRS law says that you have to spend more than 50% of your time on a business day, 8-hour day, of attempting to earn income. So if I'm spending 4 hours and 1 second on my business and I'll leave, I'm done for that day. Now I can do whatever I want to for the rest of the day, and that be tax deductible. The only caveat is entertainment. So entertainment, you cannot write off anymore. That used to actually be included up until 2018, and that went away. Somebody is unmuted. John Robinson. John Robinson. Let me meet you. Okay. All right. So the next step is, let's say, Saturday, Sunday. So I get in Thursday, don't have to work. Friday, work 4 hours and 1 second. Saturday, Sunday, or a weekend. So I can actually sandwich that in and not have to leave and be able to write that all off if I'm working on Monday. So Monday, let's say I have the event, it's 4 hours and 1 second. I'm done for the day by 12 o'clock. I go spend the day with my family. Tuesday, let's say that I meet a couple clients that day. I spent my 4 hours and 1 second. Wednesday, do the same thing. Or here's the great part. I could spend 8 hours one day and then have 2 days off. Now, by Wednesday, I'm flying back home. That's another travel day. All of that would be 100% tax deductible for you. So, and you can take your spouse and your children along with you if they are helping you earn income. You can also do business retreats. So there's so much and so many ways to be able to write off expenses, especially travel. So just keep that in mind. And we can go into more detail. If you guys have questions at the end, I'll be happy to answer your questions. But I want to make sure we get all through this completely. So, and I don't want to go over much of an hour. I want to be cognizant of your time. Medical bills and insurance deduction. I talked about earlier that medical bills and insurance, you don't get to write off over unless you are have more medical bills and insurance than 7.5% of your adjusted gross income. Meaning that if you're making $100,000 a year, 7.5% of that is $7,500 a year. You would have to have more medical bills and insurance than that. So let's say you had $10,000 worth of medical expenses and bills, then you would only get a $2,500 deduction that would then go towards your standard deduction or itemized deduction. So how do we force all of the medical bills and insurance to be a tax deduction as a business expense, which will be huge, a much bigger deal than doing a standard deduction because it's on top of the standard deduction. So you have to have something called an HRA. And HRA is what's called a health reimbursement account. I'm not talking about an HSA. That is a health savings account. A lot of employees have that, and it's great. An HSA will allow you to take advantage of, you put money into a fund. That fund is then your savings account, and then you actually get to write off the expense on your tax return. So you don't have to pay taxes on that. I think it's the maximum is $7,200 that you can do every year for your family this year. As far as, so there's limitations on the HSA, and then on top of that, you still have to pay FICA taxes. If you're a business owner, you have to pay self-employment taxes. So you're still getting taxed on some of that. It's just bypassing federal and state taxes. Whereas an HRA is actually a business plan that's set up by hiring your spouse. And then in turn, you would pay your spouse roughly $100 a month. And then you would give them an employee benefit. And that employee benefit says, I'm going to pay 100% of your medical bills and 100% of your insurance. And in turn, that becomes 100% tax deductible for you. So 96% of Americans, as I said earlier, do not get any benefit from itemized deductions. If you have more than $5,000 a year in medical bills and medical insurance, it is definitely worth having an HRA in place. And we can connect you to a company that actually sets those up for you. So there has to be a plan in place. You can't just say, I'm doing this. there actually has to be a plan, and then we have to set up payroll. So we hire your spouse, we set them up, pay them $100 a month. You get the HRA in place, we get to write off the medical expenses, and we can help again with you, help you get this taken care of. Another thing that most people don't know about is something called, they know about business use of home, but they don't know about something called the Augusta loophole. And the Augusta loophole is very beneficial. We use it on every one of our corporate clients. And the reason why is because you get more benefit from doing the Augusta loophole than you would off of business use of home. So business use of home is pretty much a percentage of all of your business expenses, your insurance, property taxes, mortgage interest. You can depreciate the house, you write off repairs and maintenance, but it's just a percentage based upon the square footage of your office divided by, or the square footage of whatever you're using the house for, that percentage or that square footage divided by the total square footage of the house. Now, the Augusta loophole, what that does is that actually allows you to rent your house out to anyone. It doesn't have to be your business. It could be to anyone. The name came from Augusta, Georgia, when they had the masters. And what they started doing is allowing you to be able to rent your house out 14 days a year without having to file that or claim any income on that. And so what that looks like for you guys is if you have events at your home, you have people come over, it could be prospects, it could be clients, it could be that you're doing an event at your home, like a continuing education event. You can actually utilize your house as you would a hotel or an event center. And so the typical, hotel is the going rate is $500 to $1,000 a day. You can rent that back to your business. Let's say $1,000 a day, that's $14,000 a year that you can actually claim as a business expense that you don't have to claim as income. So that's a huge deal. Most people have no clue about the Augusta loophole. We utilize this every day with all of our corporate clients and some of our personal tax clients. So again, if you're utilizing this, it has to be done in a manner that you are having people over to your home. Or again, you could rent out your house. You could actually rent your house out if you wanted to, like almost like an Airbnb. The other thing that I really love to talk about is continuing education. When I started, I'll tell you that, I hated taxes, and I shared that a little bit in the beginning, and it wasn't something that I ever wanted to do. So I went to college, got a 5-year degree, graduated by the time I was 20 years old. I worked one tax season, actually didn't even make it through the tax season, and I quit in the middle of February. And I swore I was never going back to taxes. And so I tried my best to do everything I could outside of January through April, because I've always done taxes since I was 19 years old. I've been doing taxes during tax season. But on the off season, I would try to do anything but. So I've had retail stores, and I had an insurance company, I had an advertising agency, and I've done all of these different things. And so in 2017, I actually showed up to a Tony Robbins event and made the decision, because I spent $50 with him, for this event, and I made the decision that I was going to actually put forth a full-time effort into our business. And at that time, we were doing about, $50,000 a year in accounting. And we've been able to grow that practice now to $3.6 million 8 years later. Life is just complete. It hasn't even been 8 years. It's been about 7.5 years. So, had I not gone to that event, I never would have taken what I do well seriously, because I hated the paperwork side of it. I wasn't really focused on being able to provide strategy. And so I learned some things in that meeting or in that event that actually helped kind of catapult me to a point where I understood, like, there's not a lot of people doing what I'm doing. And if I really just took that and ran with what I love to do, that we could continue to grow a really massive practice. So if you're going to continuing education events, obviously the travel around that, the meals, you can do market research. So if you wanted to go look at a business that's doing kind of the same scenarios, if you're in the rental property industry and you're going to go look at rental properties to buy and invest, those are also tax deductible for you. So there's just so many things out there that in so many ways to force almost everything that you're spending money on to be tax deductible. Now, business structure. So we talked about some expenses. We're going to talk about business structure now. And one of the things that I really love is for you to have an LLC. And the reason why I say an LLC as opposed to doing a corporation is because it is far less to set up an LLC. We charge $250 to do that. Plus there's a filing fee typically for the state. Some are as little as $25. Some are as much as $300. Doesn't really go over that. But if you have the LLC in place, that limits your liability, but it also allows you to later treat that LLC as an S corporation for tax purposes. And the benefit of having an S corporation for tax purposes is that it allows you to keep more of your money. So what it looks like, so let's just say you made $60,000 a year from your business. You would have to pay self-employment taxes of 15.3% if you don't have a business structure. So if you have a Schedule C, a sole proprietorship, a partnership, or just an LLC, you're going to pay self-employment taxes on the net income from your business. So 60,000 times 15.3%, that looks like $9,100 in self-employment taxes that you would pay. Plus you would also pay federal and state taxes. Now, there's a way to get that money back, and that's by taking the LLC and treating it as an S corporation for tax purposes. Now, if you have an LLC and you have been doing it wrong all along, we actually can go back 3 years from today's date of filing, actually 3 years and 75 days from today. So that means we could go back to 21, 22, and 23, amend your tax returns and get you back money. 22, 23, and 24. So we could do this for those past 3 years and go back and get you money that you would have overpaid. Or if you owe money, we can obviously wipe that tax liability out by doing an LLC treated as an S corp. But you have to have the LLC in place first, which is why I told you in the very beginning, go ahead and get an LLC, and then when you start making more money, then we can later treat that as an S corp. So if I take the same $60,000, what we would do is process a payroll of 20% of your net income. And so that either looks like issuing a 1099 for 2024, or moving forward 2025, we would start payroll typically fourth quarter. And so 20% of the net income would be paid in a paycheck. So that'd be $12,000. And then you would only pay self-employment taxes of the 15.3% on that 12 grand, which is $1,800. So instead of paying $9,100 that we just showed, you're going to now pay $1,800, which is over a $7,000 savings. People ask me all the time, when do I decide to be an S corp election? So definitely, regardless of the industry that you're in, I would say get an LLC in place the minute you start a business. If it's a traditional business, if you're in the network marketing industry, you can wait until you're making about $1,000 a month after or before expenses, so gross income. When you want to put the S corp election in place is when you're making between $12,000 and $15,000 a year, depending on the state. It's a little bit different. But that's kind of the equal playing field, meaning that you're going to pay in as much in taxes at that point as you would pay us roughly to do the extra work that it takes to do the corporate return and a personal tax return. But the thing is that the money that you pay for legal and professional fees, regardless if it's us or anyone else, that's a tax deduction, whereas the money you pay in taxes is not tax deductible. So even though you might be paying the same amount of money, at that point it becomes even and you get to take a tax benefit for the next year. So, and I'll tell you two other reasons why I really like S corps. You're 10 times less likely to be audited. I told you at the beginning, I've only ever had 3 clients audited for an S corp. And we won 2 out of the 3 of those. Actually, we won the third one, but the lady had taken $100,000 loss for 25 years. And the IRS finally came back and said, you can't do this anymore. This is clearly not a business, and it's definitely a hobby. So they didn't make her go back and pay in taxes, but moving forward, we just couldn't. So I feel like that was a win. On top of that, and we talked about this a little bit earlier, is the tax benefits of having that QBI deduction. So as a business owner, you only pay taxes on 80% of your income. So I'm not going to go back into more detail on that because we've already shared that. Now, another deduction that I really love are charitable contributions. And I told you before that there's limitations on charitable contributions. And as a W-2 employee, that falls under standard deduction or itemized deduction. But as a business owner, you can actually force your charitable contributions to be a business expense. And there's two ways kind of to do that. One, if you are giving to a nonprofit organization and there's advertising attached with it, obviously you're attempting to earn income and trying to get more business because there's attachment or advertising attached to it. But if that's not the case, then you combine your passion and your profits. And I truly believe if you help enough people get what they want, you'll automatically get what you want. And the purpose of OTB tax, I created this, 5 years ago, is to teach more people how to save more money so they could have more, live more, give more. And then I could in turn nourish more and free more people. And so a couple of nonprofits we work with, one is called Manna Relief. That's really my passion. They provide advanced immune support to children in need, and especially medically fragile kids. And so what we have done is we've taken a percentage of our gross income and given that so it doesn't matter how much money we make net, doesn't matter how much money we bring home, it matters how much we're given from a gross income level. So you can do the exact same thing. You could say, hey, for every dollar, I'm going to do this, or I'm going to give a percentage, maybe 2% of every dollar that I make in gross income. I'm going to give this to a charity and do this with it. As long as that is part of your business model and you continue to do that, then you can force the 100% of your charitable contributions to be tax deductible. So now you're getting they're no longer charitable contributions, they're considered cost of goods sold. So now you're getting cost of goods sold, plus you're getting your standard deduction. So see how that can be very beneficial because you're doubling up. We've been able to provide over 10,000 servings of advanced immune support. So that, that makes my heart happy. But that's also a huge tax deduction for me. And I would not be able to give the amount of money that we give if I did not get the tax benefits from it. So, and same thing with you guys, you give more money if you had it. But if you don't get a tax benefit from it and you're paying tax on the money, literally you're now giving away 1.3% of every dollar that you bring in because you're not being able to write off on taxes. And you don't want to leave money on the table. So again, I talked a little bit about this, but if you have been structured improperly, or you didn't take expenses that you're entitled to take, we actually can go back and amend your tax returns. We can go back 3 years from the date of filing. So this year would be, we'd actually do 21, 22, and 23. I talked about the S Corp. S Corp's elections are a little different. They're 3 years from today, not from the date of filing. So an S Corp, you can go back to 22 through 24. Amending returns, you can actually go back 3 years. So 21 to 24 can all be, reviewed and amended. And then 2 years from paying. So I actually have clients that we're going back all the way to 2015 right now that they owe money, and we are amending their tax returns, adding in expenses. Not a whole lot I can do with structure, back that far. But if they owe money, which they do, and plus they're getting hit with massive penalties and interest, we're going back and amending their tax return. And even if we could find $3,000 to $5,000 in tax savings, that may be as much as $7,000 or $8,000 in tax benefit to them, because not only is it wiping out what they owed in taxes to start off with, but it's also wiping out the penalties and interest on top of that. So we can definitely help with that. And guys, there's so much more. Like I could spend 15 hours with you telling you all the things that you could possibly do to legally, morally, and ethically keep more money in your pocket. By, the business structure, the deductions, limiting payroll for yourself. And then on top of that, if you're making more than, typically it's $400,000 a year. If you're a married filing jointly, $200,000 a year if you are single. which puts you roughly in a 32% tax bracket. So if you're in that tax bracket or higher, there's even more ways to save money, investing in things like natural gas or conservation easements. So, it really does require having a conversation with you, which we typically charge, $99 for a tax strategy session. It's 30 minutes, and it's me literally saying, this is everything you should have done. This is the structure you should be. This is how much money I think you overpaid in taxes. This is how much we'll charge to go back and fix it if you want us to fix it. And this is what you need to do moving forward. So, and then also other investment options. I am not a fiduciary. I'm not a financial advisor. I don't get any commission from sharing that information with you. But my job is to connect you with this, anyone that I can possibly do to help you free up this money. So a lot of times I will, investment options. I invest in conservation easements. Well, it's not really an investment, so I won't get involved in what that is. And it doesn't probably apply to most people on this call. But I do a conservation easement every year. We invest in natural gas, and then there's other options that you can invest in. So again, as a W-2 employee, you're going to make money, you're going to pay taxes, and then you're going to buy some of your wants and your needs, hopefully all of your needs. And as a business owner, you're going to truly make your money in your business. You're going to have business expenses. Some of those are going to be living expenses redirected as business expenses. Wants and needs really is what I say, and then you're going to pay taxes after that. So it truly is the wealth system. And so don't be brain dead. Like, take advantage of the tax code. That's what it's there for. And decreasing taxes is truly the fastest way to wealth. At the end of the day, just a little bit in summary, there's never been a time to start a business if you haven't already started, or start attempting to earn more money, because obviously you get more tax deductions as you attempt to earn more money. Take the deductions you're entitled to take. Don't let anyone tell you that you can't write this off, or this is not a tax deduction. I mean, I literally had a client that we wrote off an entire $250,000 Porsche tower. He was renting the Porsche tower for work because he had hosted events, tons of events, had people come over, and we were able to write off that because that wasn't his primary residence. He went there and stayed to grow his business, and we were able to write that all off. And he was actually audited, and that was approved and allowed. So there's just so much that we just don't know. Hiring your family, definitely. I talked about why hiring your kids, why hiring your spouse is very beneficial, and hiring an accountant. One of the things that most people don't realize, sure, you can go out and do your own tax return, but if you do, you are more likely to be audited. And they may not come after you for business expenses, but what ends up happening is somebody will check a box wrong. They'll input something incorrectly on their tax return when they're doing the paperwork, and they end up getting audited, and it opens up the audit for the entire thing. I've had two different clients that in the same year that owed over $250,000 because they disallowed almost all of their business expenses, and the audit had nothing to do with business expenses. They just checked a box wrong on the tax return, and that triggered the audit, and then it opened them up. They didn't have any bookkeeping. They didn't have a lot of their receipts, and so the auditor just disallowed all of the expenses. It's also just as important to have an accountant. What we have to do when we do your accounting is we have to do due diligence. And so we have to tell the IRS and the state that we are utilizing your information, that you provide this information to us, and in our best judgment, we're providing this tax return. So an accountant that is super conservative, or someone who is arguing with you constantly about different tax deductions and saying, hey, your business isn't legitimate because you're home-based, or blah, 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 you're not making enough money, you can't write these off, they're not going to go along with you in an audit. So I just say it's very important on who you hire to do your taxes. And then tracking deductions, that is super important. Guys, I would tell you that is one of the most important things that people miss the mark on. We do bookkeeping in our office. We also, anyone who makes under $150,000 a year, we tell clients that they're better off to do their taxes on their own, or their bookkeeping on their own. But, you know, if you start making more money, you should obviously, that would be something you want to maybe source out. And I'll give you the link to buy that or to utilize the software called Hurdler. It's very beneficial in just a second. And this is just to book a tax strategy session with us. So I promised you in the beginning that I would provide you with a link to book a tax strategy session with us. This is a 15-minute link. Obviously, we can get a whole lot done in 15 minutes as long as I have a copy of your tax return, your prior year returns. I can tell you exactly what we need to do. You're welcome to upload 3 years worth of returns if you want to, or you can upload the prior year return. So as soon as you book that, the staff member is going to send you our access to our management system. You'll upload your copy of your tax return. I will call you on that appointed time, and we will discuss what you can do, what you should do, and how much money we could save you if you wanted us to go back and amend how much money we charge moving forward. It's not a sales call. It's literally, here's the information. This is what we charge. If you want us to do the work, here, we'll send you an invoice. If you pay the invoice, we'll do the job. So, I pretty much, I don't think I need to sell you on anything. I think if you want to do business with us, you will. If you don't, you won't. So, again, here is a couple other links. This is the same tax strategy session link. So I thought it might be good for you guys to take a picture of that. You can share it as well if you want to. There's also a link to connect, refer, and earn. So we do have a referral program. It's $50 for every person who books a tax strategy session with us. You get a referral. If you're our current client, we typically will just credit your account for that. We check it every month and we'll credit the account. If you're not a current client with us, we will reach out to you and get your information so that we can then send you a referral bonus for that. But as far as the bookkeeping software, I told you I would share that with you. That's at the bottom. That is called Hurdler. And it's really great. It allows you to pull in your bank statements, your credit card statements. It'll pull the actual transaction, the date of the transaction, who it's to, the amount of money that it is. And then it just asks you, is this business or personal? And if it's business, what is it? If it's personal, you don't have to touch it at all. So on the business side, it might be travel or auto or cell phone or internet or meals or mileage. So not mileage, but auto expenses. So all of those, it's just going to track, and over time, it'll generate a P&L for you, which is a profit and loss statement, which is needed for you to prepare your tax return. Makes life a whole lot easier than using an Excel spreadsheet. This software also allows you to pull in your receipts. You can take pictures of receipts either on your phone or the computer, and it will create an audit log for you, so making you much more audit proof. And the last thing it will do is it will GPS locate your mileage for you. So it's very simple to use. There are lots of really good tutorials on it. It's $15 a month as opposed to QuickBooks is about $65 a month right now after the first 3 months with them. So I definitely suggest if you're a small business making under $150,000 a year that this is what you use. So you've got those links. I want to answer some questions. And again, it's not about how much money you make. It's about how much money you can keep. And so we want to do everything we possibly can legally, morally, and ethically to keep every single dime that you can in your pockets, especially now where we are in this country. So if you guys want to add some questions, I apologize. I tried to do an hour. I've never done this presentation before. I just kind of put this all together yesterday. Again, I would love to tell you 100 different things else, but maybe we will do a longer version and maybe that be a charge. But I just wanted to give you as much value as I possibly could, in an hour and 15 minutes and be able to help you understand so many business owners overpaying taxes. It's sickening. And we have to do what we can to save that money. So then we can put that back into our business. We can invest it. We can, put it into retirement if that's what you want. I'm not a big fan of 401ks and 403bs and SEPs and simples. I think that's the worst place you can possibly put your money, but we can have that conversation another day. So let me see what we got here. Yes, I did record this, and if you want me to send you the recording after we get finished, just shoot me an email. Courtney at OTB Tax. I think I sent every single person an email right before this conversation. If you want me to send you the recording, I can. I'm one who got audited, waiting to win. How long does it usually take to hear? Audits take forever, especially now. Granted, that's probably going to change after last week. President Trump ordered all federal employees to go back to work in their offices. I think they have 30 days, but the IRS was literally working 1 day a week in the office. So that has now changed. So I think things are going to be faster, but an audit could take years. Literally, they kind of keep it open. One of the things they don't tell you about as far as an audit goes is that if you're audited for 1 year, that once you get ready to do your next tax return, they can open up that year just because. And so we typically will file an extension for a client currently, and then we'll wait till the very last minute, like October 15th, to actually file that return so we can try to keep that out of audit status. But the good thing is, Elizabeth, is that if you get audited once as a business owner, it typically never happens unless there's substantial changes in the tax return, unless they find more than 25% of difference in expenses. So that's a good thing. The book Lower Your Taxes Big Time by Sandy Botkin. Sandy's in his 80s now. He's the only person I know of in this industry that actually is talking about all of these things. And I would say 90% of everything that I've learned or that I'm teaching you came from this book. So, and my book, More Relaxed and Less Taxing, is actually a condensed version of his and makes it a little easier for you to understand. His book is like 1,000 pages. Mine is 200. So give you a lot of the same content. Amex has 12 categories for expenses. Is that a good way for someone who's not so good at receipts? So if you are just using a Amex receipt, one, it's not combining all of your expenses together on different credit cards and things like that. And two, you're going to be required to provide all receipts. So a statement, a bank statement and a credit card statement, unless you have a P&L balance sheet, general ledger, the statement is not going to help you. They're going to require you to issue receipts to them. So definitely, you want to get Hurdler, set that up, start using that moving forward. My tax person won't do anything online and will not address me in home multi-level marketing. Stella, you need to find another tax preparer, period. So we handle all 50 states. Book a tax strategy session with us. We'll give you our prices, and we have a set price, guys. Like I don't think we're underpriced. We're definitely not overpriced. So we have a set price for what we charge for tax returns, for personal tax returns for the business, for personal returns. So we do have some clients that don't have, businesses. And then, we have a set price for corporate returns. So everything's pretty set. You just book a tax strategy session with us so we know how we should set you up as far as business. And okay, so Hurdler is a good expense tracking. Yes, app for personal and business. And one of the things about Hurdler, actually QuickBooks will only allow you one business that you can add in. Hurdler can do multiple businesses. So if you have, a direct sales business and you've got another business, you can actually set up two different accounts and they can merge together. You can issue one P&L so you can see it all together, or you can also do it separately. So I really love that. And it doesn't cost you more money. In New York, an S Corp is recommended. So in every state, if you're making more than $12,000 or $15,000 a year, an S Corp is recommended. And that 12 or 15,000 is net income, not gross income. Okay, so after expenses. Even in Wyoming, we can file as an S Corp even if we are an LLC, any state. It has nothing to do with state at all, period. So you are an LLC with the department or with the Secretary of State, and then you're treating that LLC as an S corporation with the Department of Revenue in your state and the IRS. So has nothing to do with what state you live in. There are just some states that charge, like California One of the reasons why we typically will go up to say $15,000 a year is that California charges an $800 fee regardless of an LLC or a corporation. So that's their minimum charge. So we look at that before we set up the LLC. But any other state, we always suggest that you have that and keep that. Okay, my book, More Relaxing, Less Taxing, Lower Your Taxes Big Time. Those are the two. Really, if you have those two books, I don't think you really need to read anything else. Okay, hey Courtney, I currently make my income in real estate. I've got 2 business ideas that are not tied to real estate. Do I need to set up separate LLCs for those 2 businesses before I start to spend money in those areas to make money? So you setting up an entity has nothing to do with the fact that you're in business or not. So the minute you decide I'm in business, you're a business owner and you get to write off the expenses. The only reason why I say to have an LLC is because, one, it's going to limit your liability, and then we later then treat it as an S corporation for tax purposes. So if they are an industry, like typically if you're in the network marketing industry and you add another business, they can be merged together. So one LLC treated as an S corp later on. If you are, let's say, in real estate and you have an accounting firm, those don't add up. You need 2 separate LLCs. And we can obviously talk about as you grow businesses, there's holding companies. So we could set up one entity as the holding company, and they can then own all of these different LLCs that kind of come into one place. So we don't have to do but one tax return. So as long as the same ownership, if you have a partnership, obviously with somebody, you wouldn't combine that with another entity that you have. So we can have that conversation, Clay. Oh, you're my client. So we'll talk about that when we do your tax strategy session if we don't talk about it sooner. All right. Thanks so much. Apologies. I'll send you the recording. Just Stella, if you'll just shoot me an email. Can we get a copy of Zoom? Got that. How about grandkids? So yes, and I did not bring that up. I need to add that to the slide. You can hire your kids or your grandkids. So can't be outside of that, like nieces and nephews and things like that. But any child that you're paying, as far as if they're your kids or grandkids under the age of 18, you can actually issue them up to $15,000 a year without having to pay taxes on it. Now, can you pay your kids more than $15,000 a year? Yes. The only reason why we say $15,000 a year is that is the limit to keep them from having to file tax returns. But children, you've got the standard deduction, which is $15,000, and then the first $40,000, if you're single, you don't have to pay taxes, or that's taxed at 10 or 12%. So portion's 10, portion's 12. So you can actually shift a lot of your income off of them if you wanted to, and pay them more money. You just need to file a tax return. And kids tax returns, we charge $100 for that, so it's not a lot of money at all. If you have kids, if your kids have to be under 18 to be on payroll, then how is college expense included? Is it only college until they turn 18? No. So when we have someone who goes over the age of 18 and then enters into college, we would typically pay them $100 a month so we're limiting the self-employment taxes because that's essentially all that you're really paying. And then in turn, we can do the $52.50 a year for college education. So hopefully that answers that question. Curious what people are using to track their expenses. Hurdler is a great one. Will you be replaying? I want my husband to listen. Yes. The health care savings account. Oh, yes. I have not looked at 2025. Russ, right? You keep me straight. So $8,500 for a family is this year. I've not even looked at that number. We just started doing tax returns this week. So just opened up e-filing on Monday, and $4,300 for individuals. The HRA, however, you can do $40,000 a year, and if you wanted to. So if you had that much in business, in medical bills and medical insurance, you can write off all of it. So there's no cap on that, and you don't have to save the money. The company that we work with will literally give you a debit card that's attached to your bank account, and you can use that debit card. And every time you swipe it, it actually will pull a report that is accumulating throughout the year on all of your expenses. You don't have to use the debit card, but it just makes it a whole lot easier to track all the expenses. And I've had that HRA for over 6 years now. Does membership health plans count? Oh, okay. It's very important. And I'm actually write this down so I don't forget. I meant to share this earlier. Medical sharing plans don't work at the same tax laws as medical insurance does. So although if you, let's say you don't have an HRA at all, as a business owner, you still get benefit from medical insurance. It's considered self-employed health insurance, but you still have to pay FICA on it. If you have the HRA, all medical bills, all medical insurance, no FICA, no federal, no state. On top of that, medical sharing plans are, which to me are by far superior to medical insurance, especially nowadays. It allows you to go to integrative doctors. You can, write off supplements, things like that. So a HRA will allow you to write off the medical sharing. If you don't have an HRA in place, you cannot write off your medical sharing plans. So hopefully that answered that. Saved me tons. Thank you, Tina. I appreciate you. Congrats, Courtney. Thank you, Mary. I appreciate you. Courtney did this for me. Oh, yes. Tina, we saved her a ton of money. I didn't even think to add her to the list. I love the quote from Zig Ziglar. Courtney has been a huge help. Thank you, Lisa. I think I need to come visit with you, Courtney. Sure, Jared, come on. We're in Greer. Courtney's amazing. Thank you so much. Wonderful. Thank you. Thank you. Thank you. Thank you. Thank you. Trying to find another question. How can someone deduct their medical if they're single and with a small business? So, one of the things that let's step back. If you have children, we could then force it to be, we could do the same thing as we do spouse payroll. If you do not have children or employees, then you cannot write off the medical bills because that is specific to an employee benefit and you can't be the employee on that situation. If you had a corporation, we could in turn add that back in. But if you're just a sole proprietorship, we will not be able to do that. Now, granted, like I said earlier, self-employed health insurance, you can write that off as long as you have an income in your business. That can be an offset, but you do have to pay FICA taxes on it. Recording. Yes, please. First off, thank you. Thank you so much, Vincent. My daughter runs 501c3 from her home. What deductions can I take for that? 501c3 is a nonprofit. You don't get any deductions from that unless you give money into it. So you could get reimbursed for the expenses that you put into that's considered charitable contributions. You get write off like 18 cents a mile for charitable miles, which is nothing. And then as far as whatever you give to the 501c3, as long as you get the document back showing this is how much I gave, then you would get a tax deduction. But nonprofits are nonprofits. Like they have nothing to do with your tax return. So you're not going to be able to write off things and get business deductions from a nonprofit. What expenses are covered with the standard deduction versus the deductions for a business? They have nothing to do with each other. So many people get this confused. So itemized deductions or standard deductions, that has to do with medical bills, medical insurance, property taxes, charitable contributions, and mortgage interest. So if you go above $30,000, if you're married, $15,000 if you're single, on those things, and there's caps, obviously we talked about earlier, then you would get the benefit. So let's say you had $35,000 in those expenses, you get $35,000 as opposed to 30. Business expenses are 100% against your income. So they're on top of the standard deduction, as well as if you're a business owner, you don't have to pay tax on 20% of your net income because that keep you out of deduction. So hopefully that helped. I feel like I'm talking 100 miles a minute. So I'm just trying to give you as much information as I can, as fast as I can. All right, let's see. My question is, if I hire my children as employees, I still get to claim them as dependents and receive the child tax credit? Yes, one has nothing to do with the other. How old can your children be to pay them? So it's been held up as precedent at age 7 in tax court. But if you have a child that is under the age of 7 and you pay them to do modeling. I actually, started, I think, at 5 years old with Lily, and I gave her my phone and I was like, just hit this little blue button and add these people. And she went down the list and added all these people into my more relaxing, less taxing page. Modeling, you can't find a model for your business for less than $500 a pop, may even be more than that. So you can actually pay them, post them on social media, and list them as models. So 7 is precedent, but you could definitely go younger if you wanted to. Thank you, Courtney. Thank you, Sean. I have a pressure washing business that makes about $30,000 a year. Have an LLC. Should I do an S Corp election? Yes. So the difference is you have an LLC treated as an S Corp, you're going to pay roughly, so that would be, if you didn't have the S Corp election, you pay $4,500 in self-employment taxes. If you did have the S Corp election, you pay $900 in taxes. So $4,500 is much more than $900. It costs about, just so you know, about $1,400 more a year for us to do all the paperwork, all the filings. So if I'm paying $900 in taxes and $1,400, that's $2,300 as opposed to paying $4,500. So double your money on that. Okay, what about paying an 18-year-old in high school? So we talked about that. You pay them up till their 18th birthday. You actually, if you have a child that's turned 18, I do this year, pay him before he turns 18, the whole $15,000, you can do that. And again, you can pay them. It's just not as beneficial because you have to withhold FICA taxes on them of 7.65%, and FICA taxes on you would pay as a matching employer. So if you're in a 24% or higher tax bracket, it's obviously beneficial for you to pay them right along. But the other option too, at that point, I've made my children owners of our company. So, and we have an S Corp, so I don't have to pay those self-employment taxes. So we can definitely talk and discuss how to do those things. Medical sharing plan. So I would suggest Liberty Health Share is a great plan. WellCare is another one I can connect you to, the owner of WellCare, if you want to reach out to me. And then we actually use Sedera for our employees. So I don't agree with medical insurance. So I don't do retirement. I don't do medical insurance. We actually pay for our staff to go to a doctor. It's like a monthly fee with a doctor's office, and they can go for free, anytime that they want to. And then over and above that, they have a sharing plan with Sedera. So those are kind of my 3 go-tos on that. Can you write off supplements? HRA, you can write off supplements. So that's answers that question. What does an EA stand for? An EA is an enrolled agent. That means they're the only credential that you can get with the IRS. So a CPA is a state board, has nothing to do with the IRS. An EA is an enrolled agent. They actually are trained by the IRS. They also I can go to tax court with you. I can handle any audits with you. And then as far as handle, obviously, tax returns. So it's the only credential you can get with the IRS. So the focus is taxes. CPAs are focused or financial. Hopefully that helps. So do you have an OTB affiliate partner in Canada you can refer? Yes, you'll have to send me an email on it. It's been a long time since I've referred anybody from Canada to him. I'll have to find him in my email, but a great guy, same strategy. He doesn't teach what I do, but he does what I do. So that makes sense. Can you use Hurdler for invoices? I missed that. Tiffany, I cannot remember. I don't think you can use Hurdler for invoices. I definitely suggest if you're using invoices that you utilize QuickBooks. I know it's a little bit more expensive, but it allows you, it's so much better when it comes to invoicing, because we have so much running through QuickBooks that there's no way that I could keep track of all of it. So you can send an invoice to the client, they can pay directly with their credit card or their bank account, and then it actually reconciles the payment back to the deposit. So it saves a ton of time. So even if Hurdler did it, I don't think it would do as great of a job as QuickBooks. Thank you, Melanie. Don't have referral links or benefits for getting colleagues to you. So yes, we do have a referral link. Here it is right here. So you would send them, if you click on that, that's actually a link tree. So it gives you tons of content. If you're our client, you don't have to pay to book a tax strategy session with us. So it has a link there. It has how to access me on Facebook, how to access me on YouTube, how to refer someone. So if if they use any link in our company, regardless of how they get on our calendar, if they go to OTB Tax website or if they use that link, it's just easier for us to track it that way. We're going to send you a credit for $50 as soon as they book a tax strategy session. Now, granted, I'm the one that actually goes in and does that, so it takes about a month before I will post it to your account, but you'll get an email saying, hey, you got a credit, and we'll put that towards it. If you want to receive that in money, then we're happy to do that as well. You just reach out to us. The insurance plans you mentioned, maybe okay. Liberty Health Share, WellCare, which I can connect you with. And then the other is Sedera. So I think all three of those are really, really good. I have experience with all three of those. Do I have to do an S Corp election in order to hire my kids for modeling? No, you actually wouldn't. Hey, so this is a caveat. So please don't do this wrong. If you have children under the age of 18, you would want to pay them through a Schedule C. And the reason why is because anyone you pay through an S Corp or an S Corp election, you have to withhold FICA taxes, and then you have to pay the matching FICA taxes. So what we do is we set up payroll for the corporate, for you personally, individually, for that 20% of net income that we talked about. And then on the kids, we do an actual kids payroll, and we pay them through your Schedule C. So money from the S Corp pays a management fee to you individually then pay the kids, and that shows up on your Schedule C. So they all run through each other, and we can walk you through that. But, payroll for kids, we charge $100 for setup, $120 a quarter. So not a whole lot of money, but that should be completely separate than an S Corp. If you have a child that's over the age of 18, there's no reason to set up kids payroll. You just run them through the S Corp. Sign up for Hurdler, and it does have invoicing. Great. And I did not know that, Amanda. So that's awesome. I don't think they did when we first started with Hurdler. So the owner of that company is a friend of mine. So we've been working with them for the last 5 or 6 years. Husband is shareholder in my S Corp. Can he still handle my HRA? Again, this is just like kids payroll. So, you wouldn't want to set up the HRA through your company, through an S Corp. You'd want to set it up through a Schedule C. And the reason why, and the same thing, like we don't charge more for kids and spouse. It's all one and the same. Doesn't matter how many, kids you have. Obviously, you'd only have one spouse, but you would want to pay that through a Schedule C and set that up. One, if you had employees through the S Corp, you don't want to be required to pay their medical bills and medical insurance. And then two, if you pay them through an S Corp, you have to include the money you pay them as income, and then it would in turn come back to your personal tax return, and you'll be able to wipe it out. But there's FICA taxes. So in order to save the most amount of taxes, we would set up spouse payroll, and then we would pay the spouse $100 a month. And then they in turn you'd have the HRA in your personal name, and then, or, it could be another LLC. It doesn't really matter, but essentially you have a federal ID number. We pay the spouse $100 a month through that Schedule C. And then in turn you have the HRA, and you'd write off 100% of medical bills and medical insurance. So Medicare premiums, yeah, that can go to self-employed health insurance. Also the portion that you pay, if you have the HRA, you get an even bigger advantage because you don't have to pay the FICA. Courtney has a slide that has a QR code for 15 minutes. Yes. Okay. Yes. So, I guess somebody posted, how did they get the tax strategy session? It's here. All right. I think that's it. Oh, hold on. Can I hire my spouse even if he has a business of his own? Yes. You can hire your spouse. So it doesn't matter if he has a business or not, but you would only want to hire your spouse. One, because you could take him with you to events and travel and things like that. If he's helping you in the business, you don't have to hire him in order to be able to write those things off. The only reason you would hire your spouse is if you have substantial, more than $5,000 a year medical bills and medical insurance, and you're not currently writing that off. So you put that HRA in place. You're welcome, Mary Jane. I hope this was very helpful. I don't think that I have any more questions. I think I went through everything. I will try my best to do this, once a month. But, it obviously gets super busy during tax season. You're welcome to share this. I will send the recording. And, I will do a further deep dive into tax strategy and what we can do in order to help people save money in taxes, because I think this is super important. And I obviously cannot address all of this on a 15 or 30-minute call. So I appreciate you guys listening in. And I appreciate you being on here. I will send, if you'll shoot me an email, everyone should have my email address. If you shoot me an email and want a copy of the recording, I'll be happy to send it to you. All right. I appreciate you guys. And again, book your tax strategy session. We'll discuss, what we can do. If you want to hire us, that's great. If you don't, no big deal. I'm not I'm not trying to twist your hand. I just want to make sure we can obviously save people as much money as possible. So, all right. Thanks, guys. Y'all have a great day. Let's see.